last night, we saw the price of silver get hit as it's approaching $100, which is a very big bad thing for the traders offside. So they dump a ton of metal onto the market, and at the same time, what exposes that? Last night, in the middle of the night, a whole bunch of contracts dumped. The lease rates went shooting up. The 100 is the big psychological number. Right. That when will it happen? It will happen when there is a failure to delivery or systemic risk. I wonder if TD is in the Bank in Canada that they're talking about trying to get people to dump their metal. Higher premium in Shanghai, about $8 an ounce continuously over what we're seeing here in the West. That arbitrage is just a vacuum. Every time the price gets dropped, bang, it goes to the east and it ain't coming back. Could these metals drop next week? Of course they could. And I'd actually be surprised if we don't get some sort of frightening pullback along the way. But at the same time, and it's called shaking the trees. Because right. You get all those players on margin who fall out, cover their positions for whatever degree they do it, and who comes in to push the price right back up to $92? The big traders that are standing for delivery who do not use margin. This is where technical analysis, which is very valid, and I think it is, right?
As a technical analysis, technical analyst, yeah, I've got to say, it's interesting.
It is, but this is where I think there is a flaw. Now, okay. I think that it's indisputable that silver has been suppressed. Let's just talk about it for one moment. Yeah. 8 Western banks, 8, have held for many years the largest concentrated short position in any of the 1,000 commodities traded on COMEX ever in the history of the COMEX. 8 Western banks holding the largest concentrated short position in this tiny little product. Now, why would they do that? That's the first question. Why would 8 Western banks find it important enough to maintain a wickedly concentrated short position in a commodity like silver? Now, my thesis for years, and I've done hundreds of podcasts on it, and I rarely get backlash on it. Once in a while, guys like Jeffrey Christian will question me, but all you need to do is go to silverwars.com or silverwars.org, either one of them, and take a look at the amount of silver that is indeed inside of all of these military components. Now, I have a client who works for the Department of Defense who validates much of what I have said publicly, but that there are hundreds and hundreds of ounces inside every one of these high-tech missiles, like a cruise missile, a Patriot, or a Tomahawk in the guidance system.
The chart may look clean, but the positioning beneath it tells a very different story. As Andy Schectman points out here, technical patterns lose meaning when a market is dominated by 8 banks holding the largest concentrated short position in COMEX history. That level of concentration isn't normal price discovery, it's structural control. When silver is embedded in defense systems like Patriot and Tomahawk missiles, demand isn't speculative, it's strategic. The CFTC data consistently shows silver's short concentration far exceeds other commodities, yet analysts still treat it like a free market. The disconnect matters for investors relying on charts alone. And next, Andy Schectman explains why this suppression narrative ties directly into national security, not just market mechanics.
Some of these new missiles move at hypersonic speeds, and they must have silver, which has properties that will allow it to maintain its integrity at very, very high temperatures. But let's just play it out. So the West, not just the United States, the UK and France, and all of the industrialized West who has maintained high-tech military, and the military, that is the arms and the weapons that are sold to NATO, all come from the military-industrial complex, the Western companies. So in essence, holding down the price of silver was less about its price going too high and more about the realization that it's vital. And so they've held it down for a very, very long time by suppressing, by naked shorting. And this isn't a guess. I mean, look at JP Morgan. Although many people thought they would get RICO charges, they paid a $920 million fine to the Justice Department for manipulating metals. They called it spoofing, which was a joke. It should have been much more, but that's the largest fine the Justice Department ever handed out at that point. And yet they're still allowed to be the custodian of the world's largest silver fund, silver trust, SLV. Their co-custodian is BlackRock. Who is the military-industrial complex? It's largely the companies that are owned by BlackRock.
Suppression isn't a theory when fines are already on the record. As Andy Schectman highlights, silver's role in hypersonic weapons reframes price control as a cost management strategy, not a market accident. JP Morgan's $920 million metals manipulation fine wasn't symbolic. It confirmed years of irregular trading behavior. Yet the same institutions remain custodians of major silver ETFs, creating a conflict Wall Street rarely acknowledges. When defense contractors rely on cheap silver inputs, price stability becomes policy adjacent. Investors should question whether ETF prices truly reflect physical scarcity. Up next, Andy Schectman connects this structure to who actually profits when silver stays artificially cheap.
And so when countries like the Ukraine get blown up with missiles that have huge amounts of silver in it, keeping the price low, who gets the reconstruction contracts in places like the Ukraine? That's right, it's BlackRock. So this has been something that's been going on for a very long time, that these 8 Western banks have suppressed the price of silver in order to maintain strong military, in order to sell weapons all around the world, in order to, I guess you can say, maintain Western hegemony through strong military force. You must have silver that is not realized for what it is. But several years ago, that started to change with India and China going to great lengths to accumulate silver, and we're seeing that expand, and through delivery. And it is the stress of the delivery that is breaking the system. Article in the Economic Times just came out and said that the 5 U.S. banks have flip-flopped and gone net long. And it's leaving the banks exposed in Canada. By the way, TD Bank was just stopped out of a short position, and they wrote a letter saying, calling it the devil's metal, and that we think it's at top and it's gonna collapse at $92. They were stopped out. They're one of the banks that are supposed to be short.
The players preaching collapse are often the ones already trapped. As Andy Schectman notes, when Eastern buyers like China and India demand physical delivery, paper control weakens fast. The Economic Times reporting on US banks flipping net long while Canadian banks hold shorts exposes a fracture in the system. TD Bank being stopped out near $92 isn't random. It signals stress, not exuberance. Shanghai premiums staying $8 above Western prices show real demand pulling metal east. That's not speculation, that's flow. And next, Andy Schectman explains why delivery pressure, not headlines, is what finally breaks manipulated markets.
All I'm simply saying is this. The acknowledgement that gold and silver have not been freely traded for a long time paints a different picture when looked at through the lens of technical analysis, because I think it's never been allowed, and I would argue gold too, all the way back to the London gold pool. They have never been allowed because gold and suppressed interest rates, thesis is called Gibson's paradox. They're inverse of each other. You suppress interest rates, you got to step on gold. It was done to maintain the dominance of the Western system. Silver to maintain the dominance of the Western military complex. Bottom line is these two items, when everything else blew up in an era of suppressed interest rates and easy money, all the assets, stocks, bonds, real estate, gold and silver weren't allowed to. It's breaking now because the rest of the world says, all we got to do is stand for delivery and this game breaks. Well, now you're starting to see, according to the Economic Times, the players in this game say, every man for themselves, and flip-flop. So I just want to paint that picture that I think looking at this through a technical lens might not have the same type of validity it does in a market that is perhaps a little bit more freely traded.
Okay, well, fair enough. And so when we see these markets being priced with liquidity every day, how do you think some investors are pricing that trust right now?
Charts fail when price is policy, not supply and demand. As Andy Schectman frames it, Gibson's paradox explains why gold had to be kept during decades of rate suppression. Rising gold would have exposed monetary distortion. The London gold pool collapsed in 1968, but the playbook never disappeared. Stocks, bonds, and real estate inflated, while monetary metals were restrained. Now physical delivery is challenging that imbalance. For investors, this means trusting liquidity-driven pricing may understate real risk. And next, Andy Schectman shifts from theory to what this breakdown means for trust in markets going forward.
Well, I think trust is everything, and maybe that's why you're seeing so much in the way of deliveries and backwardation, right? So, at the beginning of the month, and I haven't looked past Friday of last week, but through Friday of last week, we had already seen 5,451 gold contracts at 100 ounces apiece and 6,321 silver contracts. So through the first 6 trading days of January, which is not a delivery month, it's not a main delivery month, we saw 545,100 ounces of gold delivered and 31,605 ounces of silver delivered, when no one ever stands for delivery. So in 40 days, we saw 100 million ounces of silver delivered and, you know, a few million ounces, almost 4 million ounces of gold delivered. Who's doing this? It's billions and billions and billions and billions and billions of dollars, and there is no coverage of it. So to me, it is prioritized. And when you see backwardation, where the current price is, the spot price is priced higher than the futures market, that's the opposite of contango, where it's supposed to be the futures price is higher because you're paying for the cost of storage and insurance and the time value of money. That's the market's way of saying, no, I don't really trust what you're talking about. I want it now.
The real signal here isn't price, it's urgency. And markets only get urgent when trust quietly breaks. What stands out immediately is scale. Over 100 million ounces of silver delivered in just 40 days during non-delivery periods. Something that historically almost never happens. As Andy Schectman explains, backwardation flips the normal structure of futures markets and signals distrust in paper settlement, not speculation. When spot prices exceed futures, storage costs, insurance, and time value are being ignored, meaning buyers want metal now, not promises later. That kind of behavior typically precedes stress events, not rallies driven by sentiment. For investors, this matters because backwardation reflects confidence erosion in the system itself, not just a bullish bet on price direction. And as Andy Schectman hints here, what comes next is usually when the quiet mechanics become impossible to hide.
And that's the stress that we see manifesting. And at the same time, like, for example, last night, we saw the price of silver get hit as it's approaching $100, which is a very big, bad thing for the traders offside. So they dump a ton of metal onto the market. And at the same time, what exposes that? Last night, in the middle of the night, a whole bunch of contracts dumped. The lease rates went shooting up. So if you're, which means to lease the metal in order to cover a short or for whatever legitimate reason, normally those lease rates are a fraction of a percent. Not the case anymore, as high as 8 or 9%. They were as high as 30% a month ago. And what that says is that, you know, from a 0.5% normally to 8 or 9%, that's the market's way of saying, you're going to play this game, you want to lease the metal, borrow it from us for whatever reason, you're going to pay through the nose. And these are the signs showing that it's more about physical delivery rather than paper promises. And that's a scary thing if you're on the wrong side in a naked short position in a market like this. Yeah, I mean, look, those are, the 100 is the, you know, the big psychological number.
Right.
Silver didn't fall here because demand weakened. It fell because someone couldn't afford the number it was approaching. The moment silver neared $100, aggressive selling appeared alongside a spike in lease rates from normal sub 1% levels to as high as 8 to 9%, even touching 30% recently. As Andy Schectman notes, lease rates are the cost of borrowing metal, and when they surge, it means physical supply is scarce, not abundant. Dumping contracts while lease rates explode exposes stress on the short side rather than confidence from sellers. Historically, rising lease rates have aligned with delivery pressure, not healthy market corrections. For investors, this highlights counterparty risk. Paper sellers may exist, but physical liquidity is tightening fast. And what Andy Schectman points to next explains why psychological price levels often trigger structural cracks.
So look, all I'm simply saying is this, is that when will it happen? It will happen when there is a failure to delivery or systemic risk. And when you see a bank like TD Bank betting, and they came out in a publication to all of their investors, all their traders, or all of their investors, or people who trade with them, saying, we're putting on a big short position in silver right now because we think the top is in, and then it goes to 92, and they just got stopped out yesterday, the day before. So yeah, I think that you see something, a failure to deliver, which could then trigger a systemic contagion event. I don't know. I guess we'll see. But that was the whole premise of the Economic Times newsletter or letter that came out last month and said, well, the U.S. banks supposedly had flip-flopped and gone net long, leaving the bank in Canada and those in Europe holding the bag. I wonder if TD is in the bank in Canada that they're talking about, trying to get people to dump their metal, but with a substantial higher premium in Shanghai, about $8 an ounce continuously over what we're seeing here in the West. That arbitrage is just a vacuum. Every time the price gets dropped, bang, it goes to the east, and it ain't coming back.
Systemic failures rarely announce themselves. They show up as someone else getting trapped. A major bank publicly shorting silver, only to get stopped out near 92, isn't bad timing. It's evidence of structural misjudgment. As Andy Schectman highlights, failure to deliver is the real trigger, and repeated east-west arbitrage confirms physical demand overwhelms Western price suppression. With Shanghai trading roughly $8 per ounce above Western prices, every forced dip becomes a transfer of supply out of the system. Historically, contagion events emerge when institutions misread liquidity, not sentiment. For investors, this underscores geographic flow risk. Metal, leaving the West, does not easily return. And Andy Schectman's next point explains why these flows matter more than any headline price drop.
They're literally enticing any of the sophisticated traders who can buy paper in the West and deliver physical there to do so at a huge profit. And so these are the kind of things that are different that could precipitate a problem. Short of that, I think they'll just become a realization that the biggest money in the world sees silver as critical, indispensable, and that the supply-demand fundamentals just don't line up, whether we see some sort of an event or not.
Right. And let's talk about what happens to the everyday investor, the people at home that have the gold, the silver in bars. They've been stacking it up for years, and now prices are just since, let's say a year ago, have, increased in size significantly. Let's talk about those people. Because in a serious market scare, and I'm not talking about just a 1 to 2% pullback in markets, in a day. I'm talking about a serious market pullback. Are people going to be going and to the local pawn shop, selling it as much of that as possible and getting it off, or are they going to be holding it even tighter in fear of this market crash?
Well, they say, and that's a good point, they say there is no market like a gold bull market. And when I say gold, I mean silver too, because in traditional market.
The overlooked question isn't whether prices rise, it's whether holders let go when fear actually hits. Here, arbitrage incentives reward those converting Western paper into Eastern physical, reinforcing long-term supply drain. As Andy Schectman has warned, when the largest capital pools view silver as indispensable, fundamentals overpower volatility. In past market crashes, physical metal behavior diverged sharply from equities. Selling pressure decreased as uncertainty rose. For long-term investors, this reframes silver not as a trade, but as insurance against liquidity shocks and market dislocation. The real risk isn't price swings, but underestimating holder psychology during stress. And Andy Schectman's next insight explains why panic selling may be far rarer than markets assume.
Yeah, you take some of that off and leave your principal ride, and then you end up, buying another asset or something. But with this, it really isn't that way. It reinforces, I think, the fear that people have in what's happening underneath the surface, and so I think, I don't think it really. I think people expect it. Let's just simply say that some caution is always warranted after a move like we've seen. And when everyone starts talking about something as being a certainty, myself included, that's usually when the market reminds you it doesn't care about your conviction or your theory. But that said, I would separate price risk from thesis risk. And, I guess in the short term, gold and silver can certainly pull back. And in a thin market like silver, after a vertical move like we saw, Elizabeth, I would say that an air pocket or a sharp pullback or profit taking margin increase like we saw, which is a good one to discuss, headline risk, you name it. A $10 or $20 correction in silver is not only possible, it's probably normal in the bull market, but it's the underlying conditions that got us here, which are tight physical availability coupled with massive delivery demand in a paper market that is being asked to settle real world demand in real metal that they may not actually have.
The mistake investors keep making is confusing volatility with failure, even when the underlying mechanics stay intact. As Andy Schectman explains, separating price risk from thesis risk is critical because a $10 to $20 silver pullback in a thin market is historically normal after vertical moves. Silver has repeatedly seen 15 to 25% corrections during past bull phases, while demand fundamentals tightened underneath. The real issue isn't price action, but whether physical availability can meet delivery obligations in a paper-dominated system. For portfolios, that means short-term drawdowns don't invalidate long-term positioning when supply stress persists. And as Andy Schectman emphasizes next, it's the conditions beneath the price that ultimately decide the trend.
So yeah, I mean, if you're asking, could these metals drop next week? Of course they could. And I'd actually be surprised if we don't get some sort of frightening pullback along the way. But at the same time, I think that you could argue that dips like this in this market are a gift. Why? Because they're actually driven by positioning and leverage, not by a sudden surplus of metal. And so what I mean by that is that if you look at who's standing for delivery here, right? These are this is the biggest money in the world, who is spending billions and billions and billions and billions and billions. So you get someone with a $20 million position or margin account or money in their account, and they want to start buying metal.
Right.
You know, they're normally, when the CME group raises margin, it knocks the price down hard, because you get a lot of people who, let me explain it this way. They raised margin twice in about a 2-week period. The second one was on December 26th, day after Christmas. On Christmas Day, you would have needed 21,000 in your margin account to control a 5,000 ounce silver contract, about 300,000 at the time. Okay, so that's huge leverage, right? Well, the next day, the day after Christmas, they said, now you need $7,000 more approximately.
When prices fall in this setup, it's not metal flooding the market, it's leverage being forcibly unwound. Andy Schectman points out that CME margin hikes, like the December 26th increase from roughly $21,000 to about $28,000 per silver contract, historically trigger forced selling, not genuine supply changes. That leverage shock flushes smaller players, while delivery demand from capital with billions remains untouched. This creates artificial downside that looks bearish on charts but isn't confirmed by physical flows. Investors should recognize that margin-driven drops often reset positioning, not fundamentals. And Andy Schectman's next point shows who actually benefits once the leverage is gone.
So you need 28,000. And a lot of people got margin called because they may have 30 trades on it margin. They have to sell a bunch to get the margin money back, or the money back to cover their margin. And as they sell, it drives the price down higher. So as the price is falling, coupled with an increase in margin, the price really falls. It begets selling, begets more selling. And it's called shaking the trees, because you get all those players on margin who fall out, cover their positions for whatever degree they do it. And who comes in to push the price right back up to $92? The big traders that are standing for delivery, who do not use margin. They don't care. You're talking the biggest money in the world. Yeah, so what I would simply say is I think it is possible for short-term caution and long-term bullishness to coexist. And I think that's where we are right now. So I wouldn't sell if we see a pullback. In my opinion, my conviction has never been stronger on a long-term basis, but I understand the short-term caution, and I agree. I just think that it's the traders at the highest level that have been pushing the market up, period. It's been the sovereign wealth funds. It's been these central banks that have been doing it. And so I would argue it's less the investors, even sophisticated investors, if I'm understanding you correctly, who get knocked out and come back in.
What looks like panic selling is often just smaller players being forced out by rules they don't control. As Andy Schectman describes, margin calls cascade when leverage is high, pushing prices down until non-leveraged buyers step in. Silver snapping back toward 92 shows that delivery-focused capital doesn't react to margin pressure the way traders do. Sovereign wealth funds and central banks operate without leverage constraints, giving them patience retail investors lack. For long-term holders, this dynamic explains why pullbacks don't erase the broader trend. They transfer exposure from weak hands to strong ones. And Andy Schectman's next example makes that transfer impossible to ignore.
They're not the ones pushing it up. In other words, they're the ones falling out. And as they fall out, you get the Samsungs, the Teslas, the sovereign wealth funds, the big money that doesn't care about margin, doesn't care about a pull down. They don't use margin. It's kind of like this. I had lunch the other day with a Major League Baseball owner, and he lives next door to Mark Wahlberg, and down the street is Alicia Keys, in the craziest neighborhood I've ever been in my life. And these houses are $50 million. You think they care if mortgage rates go up? They don't give a crap if mortgage rates go up, but everyone else does. In other words, what I'm saying is if mortgage rates go up, it's not going to affect the big money who comes in and buys with cash. But everyone else, it almost be like you have a mortgage and everything's great, and then you get a call on the day after Christmas from your mortgage company saying, listen, you're going to need to post another 30% against your house, or we're going to confiscate your house on Monday morning. So that's exactly what it's like. Now the big money would say, fine, here we don't have a mortgage, so we're not getting that phone call. Everyone else has a problem.
Markets don't reward fairness. They reward whoever can survive forced pressure the longest. Andy Schectman uses this analogy to expose how margin rules disproportionately punish leveraged participants, while cash buyers remain unaffected, just as rising mortgage rates barely touch ultra-wealthy cash buyers. Rising margin requirements don't slow institutions buying metal outright. This creates a structural advantage where volatility becomes an entry point for dominant capital. For investors, the lesson is risk management, not timing, because leverage determines survival more than conviction. And Andy Schectman's final warning shows what happens after the smaller players are cleared out.
And if that were to happen and everyone had to close, get defaulted on their house and get kicked out, well, here comes BlackRock to buy the whole neighborhood. That's in essence what it is. And that's what we have been seeing, I believe, in these violent moves. So it's not like the market is coming up with all this new product, gold or silver. It's just that when you go in on leverage and you're competing against the biggest money in the world, you better think twice, and you better have very strong fingertips. So the CME group always comes in to go after the longs and protect the banks. Raise margin, raise margin, raise margin. It's not working this time. It did in 2011. The difference now is that you have sovereign nations, the European Union, China, the BRICS nations, the United States, they're all competing for the same small pool and realizing what everyone else, they understand what we're doing now. They know that, we better take delivery. Let's call it tariffs. It was never tariffs, it was reshoring. And you can see that the whole tariff thing about precious metals, I believe, was a ruse to reshore all the metal, because we were net exporters of gold my whole career.
This isn't a free market reset. It's a consolidation by entities that can outlast volatility indefinitely. Andy Schectman highlights that, unlike 2011, today's buyers include sovereign nations competing for a limited physical pool. Margin hikes that once crushed demand now fail, because state-level capital prioritizes delivery over price. The reshoring narrative masks a deeper shift. Metal is being pulled inward as strategic inventory, not traded. For investors, this reframes silver and gold as geopolitical assets rather than speculative vehicles.